Good morning, ladies and gentlemen. In this video, we're going to talk about the key macro trends, an update on earnings driver for brand equity portfolio, and the outlook going forward. On the macro front, the global fundamentals continue to be challenging, while on the local macro front, the monsoon turned out to be better than expected, and retail inflation was under control. On earnings driver front, while the pre-festive demand check point to a weak demand scenario, government has come up with a slew of economic measures to pump prime the economy from the growth recession that we are seeing so far. The most important of this has been the corporate tax rate change from 35 to 25% for the existing corporates and to 17% for the new manufacturing setups to be set up before 2023. These tax rate cuts turned out to be a meaningful shot in the arm for equity markets in the short term. While the prime beneficiaries of the same are the companies with highest marginal tax rate, it also makes India globally competitive for future capital formation going forward. However, to get to the true beneficiaries of the tax rate cuts, one must resort to what Howard Marks calls second-level thinking in his famous book, The Most Important Thing. In this context, I would like to highlight that the companies that truly benefit from tax rate cuts are the ones which retain the benefits of the tax rate cuts that the taxman provides. The companies in such category are likely to be companies with pricing power, i.e. brands, companies that can retain their benefits yet not impact their demand. In other words, the price elasticity of demand for their products is low. Furthermore, as these brands invest or plow back these retained savings into the business of their own in areas like advertising spending, R&D spending, or channel investment perspective, this will create a virtuous cycle for demand for their products and services going forward. In other words, we think that our brand equity portfolio is a true beneficiary from these tax rate cuts over the medium term. Finally, we are pleased to report that our brand equity portfolio has stood true to its character of wealth preservation first, wealth creation next in terms of dealing with equity markets over the last 2 years. And that can be seen in our performance in falling markets as well as that of rising markets. Also, we have reduced the cash levels in our portfolio by taking advantage of the weakness in equity markets over the last couple of months by investing back in our stocks which had fallen down or some of the new stocks as well. On net balance, we feel quite positive, quite constructive about our portfolio going forward. On this happy note, we wish you a very happy festival season and happy investing.